Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. I want to touch on three buckets this morning. Obviously, the markets are extremely volatile. The first coming out of last week, and a very big thank you to Fox Business and Maria Bartiromo for including us again to talk about these dynamics coming out of the Fed meeting. So let's get right to that, right? There are a couple of themes in the market right now relative to the Fed. One is front loading. And if you look at the summary of economic projections last week, you see that front loading in 2022 with the Fed funds rate getting in and around 4.4, which implies another 125 basis points of tightening for this year. The other theme is restrictive, 3 to 3.25 now. Chair Powell had neutral at 2 to 2.25, where we don't run it too hot, too cold. The Fed needs to get restrictive to exert downward pressure on inflation right now. So where does the Fed see that rate getting to? Ultimately, in 2023, the Fed now has a terminal rate in and around 4.6. For context, earlier in the year, the market had that rate at 3.25. So we have seen a very dramatic repricing there. The other, in conjunction with getting to restrictive territory, sufficiently restrictive, is higher for longer. So it could imply over time a lower terminal rate in general, as the Fed at some point does take a step back here to evaluate the lag in terms of how these rate increases are flowing through. But going back to history, Chair Powell saying the Fed is reluctant here to commit some of the mistakes of prior times where the Fed was very quick to lower interest rates. Now, we do think when rates ultimately come down, they could come down quicker. But keep in mind, they're going to be coming down from a higher resting spot. Call it 4.5% to 5%. The market has it now at 4.75% in terminal pricing. Back in 2008, we got a little bit north of 5% right before the housing crisis. The real rate interest rate structure. If you look at 10-year real yields last year, when the Fed was really trying to add liquidity and drive risk assets higher, we do think they clearly overdid it. Now we have the exact opposite phenomenon as the Fed is trying to impact financial conditions through higher real interest rates. 10-year real yields last year, negative 120. In this pocket of time now, especially coming out of Jackson Hole and with the recent hawkish stance of Chair Powell and the committee, 10-year real yields now at 140, the highest levels we've seen in quite some time. The chair wants to see real yields positive, including when you look at spot inflation, positive across the yield curve. And then the unfortunate part, the pain in the marketplace. How do we get demand to be below trend for an extended period of time? How do we get that inflation down? Certainly, it points to the housing market. If you look at owner's equivalent rent, we are seeing a lot of inflation coming out of the housing market. The Fed chair pointed to that specifically, that we still have a supply-demand imbalance in housing, which is beginning to correct itself, but likely a correction in prices over time. And then the unemployment rate. We did see the unemployment rate tick up last month as a function of labor force participation going higher, but we still have this supply-demand imbalance on the labor side of the equation. In our view, it's unlikely the Fed succeeds in getting this core inflation number back down closer to 2% without driving that unemployment rate higher. The next bucket I want to talk about is this window of time rates. In our morning meeting this morning, a lot of questions, what exactly is going on in the rate market right now? And I point to three things. One is the terminal rate, the hawkishness of Chair Powell and the Fed right now saying, look, we see this terminal rate as higher. And as a function of that, we have had long end nominal and real yields dragged alongside of that. And that hawkishness has been very real. For context, earlier in the year, we had a 250 10-year note and we had a 3.25 terminal rate being priced in the marketplace. Now we have a 4.75 terminal rate and a repricing of long end yields in conjunction with that. The second thing here is clearly the global rate story. The global rate story over inflation, a central bank paradigm shift that we haven't seen in quite some time, the last decade plus of negative to zero interest rate policies being obliterated in a matter of 8 months. In the course of 2022, we saw the release of some of these policies globally beginning in the summer of 2021. That global rate shift has given the chair here cover. It's given the Fed cover to raise interest rates, albeit on a relative basis, albeit with the dollar being king here, albeit with the yield curve inverting. It's given the Fed cover here and the ability for U.S. rates to shift higher, for the Fed to get that Fed funds rate higher within this window of time. The last thing within this bucket is liquidity, and perhaps the most important thing. It's something we wrote about earlier on in the year where we saw inflation being more persistent. We thought the Fed was going to need to go. The chairman pivoted toward the end of 2021 with regard to QT, and all of these factors here colliding at the same time is critical. The Fed, central banks in general, they cannot transmit central bank policy effectively without the proper amount of liquidity. And for a good part of 2022, we have had a decent amount of liquidity. But if you look at the European Central Bank, if you look at the peripheral spreads there, clearly the ECB ran into a hiccup. If you look at what's going on in the UK market right now, we're moving 50 basis points a day in 2-year UK yields. We've moved 150 basis points within 120 days. And certainly liquidity questions are arising and are here with regard to the US market. So liquidity is very important. And we've seen this in pockets of time, 2002, 2008, 2016, 2018 in particular, at the end of 2018, certainly in 2020, when the pandemic hit, we have seen those liquidity challenges with regard to the US market. This is something the Fed is going to be watching, and they do watch very, very closely. But we do think as 22 matures, okay, the Fed is going to need to keep a much closer eye in terms of the liquidity functioning of the U.S. market to successfully transmit interest rate policy. What does it mean for the rate increases going forward? It doesn't mean they're going to stop, but it could be a consideration in terms of these jumbo rate hikes that we're seeing now in 75 basis point clips, with the potential to move that down to 50 basis point increments short term. And then lastly, this week, we get another PCE deflator, the Fed's favored measure, expectations in and around 4.6, 4.7. The Fed has intimated that terminal rate now being right around that core PCE number. We do get another Michigan number, certainly a plethora of Fed speak across the board. We're going to try and disseminate who's in that 100 basis points left for 2022, maybe who's in that 125 basis points left for 2022. And then on the ground, we get Treasury supply in the form of 2 years, 5 years, and 7 years. I'm Greg Faranello, head of U.S. rates for AmeriVet Securities, wishing everyone a great week.